Purpose of translation examples in multinational accounting. Topic integrates the concepts of the temporal method and current rate method through comprehensive translation examples. These examples demonstrate how a foreign subsidiary's local currency financial statements are converted into the parent company's reporting currency. The process requires identifying the appropriate functional currency, selecting the correct translation method, and applying current, average, or historical exchange rates to specific accounts. The examples emphasize that translation is not merely a mechanical exercise but a process that can materially influence reported earnings, assets, liabilities, and equity. CFA candidates must understand both the procedures and the economic consequences of translation adjustments when analyzing multinational companies. Translation example using the current rate method. The subsidiary operates relatively independently, making the local currency its functional currency. Because the functional currency differs from the parent's reporting currency, the current rate method is applied. Under this method, income statement items are translated using the average exchange rate, while balance sheet accounts are translated using the current exchange rate except for common stock, which uses the historical rate. Any balancing adjustment resulting from translation is recorded as a cumulative translation adjustment, CTA, within shareholders' equity. The example illustrates how a depreciating foreign currency can create a translation loss even when the subsidiary remains operationally profitable. Translation effects on financial statements. Translation can significantly affect the parent company's consolidated financial statements despite no underlying change in the subsidiary's economic performance. When the foreign currency depreciates relative to the parent's currency, translated revenues, assets, liabilities, and equity generally decline. Under the current rate method, the resulting translation gain or loss is accumulated in CTA and reported in other comprehensive income rather than net income. Under the temporal method, however, remeasurement gains and losses are recognized directly in earnings. Consequently, the same economic event can affect different sections of the financial statements depending on the translation method used. Analysts must distinguish between operating performance and accounting translation effects. Ratio analysis under the current rate method. Topic focuses on how translation methods affect financial ratios. Under the current rate method, most balance sheet accounts are translated at the same exchange rate and most income statement accounts use the average rate. Because both the numerator and denominator of many ratios are affected similarly, ratios such as current ratio, quick ratio, gross profit margin, and interest coverage often remain relatively unchanged after translation. However, return-based ratios such as return on assets may change because balance sheet accounts and income statement accounts are translated using different exchange rates. Analysts should therefore evaluate whether observed ratio movements reflect genuine operational changes or simply exchange rate effects. Ratio analysis under the temporal method. The temporal method often creates greater distortion in financial ratios because different accounts are translated using different exchange rates. Monetary assets and liabilities use current rates, while non-monetary assets and related expenses use historical rates. As a result, inventory values, cost of goods sold, depreciation expense, and fixed assets may be translated at substantially different exchange rates than revenues and monetary accounts. This mismatch can alter gross profit margins, asset turnover, return measures, and leverage ratios. Earnings also become more volatile because remeasurement gains and losses are recognized directly in the income statement. Therefore, ratio interpretation requires a thorough understanding of the translation methodology employed. Analytical implications for CFA candidates. For financial statement analysis, translation effects can complicate comparisons across multinational firms. Two companies with similar economic performance may report different profitability, leverage, and efficiency ratios simply because they use different translation methods or operate in different currency environments. Analysts should identify the subsidiary's functional currency, understand management's translation choices, and assess the impact of CTA or remeasurement gains and losses on reported results. When necessary, analysts may adjust reported figures to improve comparability. Mastery of translation examples and ratio effects enables CFA candidates to distinguish between changes caused by operating performance and those caused solely by foreign exchange movements, leading to more accurate valuation and forecasting decisions.